Hello everyone. In this video, we are going to discuss about liquidation of companies. Before we begin, welcome to Sridhar's lab. Liquidation of companies. A company is an artificial person created by law. A company comes into existence through a legal process and it also has to come to an end by law. Therefore, liquidation is a legal procedure by which the company comes to an end. The term liquidation denotes the process of law whereby a company is wound up to terminate its corporate life. That means a company being a creation of law cannot die a natural death. A corporate life of a company can be terminated only through a legal process called liquidation. Meaning of liquidation. Liquidation or the winding up of a company means the termination of the legal existence of a company. Under such circumstances, the assets of the company are disposed of and the debts are paid out of the amount realized from assets or from the contributions made by the members, and the surplus, if any, is distributed among the members in proportion to their holding. That means liquidation means the assets of the company are disposed of. That means they are converted into cash, and that cash is utilized in order to pay back the debts of the company. And after paying the debts, if at all if there is any money left out, that money is being paid back to the owners of the company, that is to the shareholders of the company. That is what liquidation is all about. Let us understand this with an example. In this example, I have taken a brief summary of a balance sheet. You can pause the video and observe the items. Equity share capital 4 lakh, reserves and surplus nil, debentures 2 lakh, bank loan 2 lakh, bills payable 50,000, creditors 1 lakh, bank overdraft 50,000, the total being 10 lakh. Under assets we have machinery 2 lakh, building 4 lakh, goodwill 1 lakh, investments 1 lakh, profit and loss account deficit 1 lakh, debtors 50,000, stock 50,000. If the company initiates liquidation, then assets has to be disposed and it should be converted into cash. In this example, if this company initiates liquidation, then they have to dispose their assets. When they try to dispose their assets, the assets would either fetch the book value itself, or sometimes the asset may be because of its nature, like building, it would fetch more than its book value because of market values, and machinery kind of things would fetch less than its book value, maybe because of depreciation. And let's take an example, assuming that this company tried to realize their assets at these values. So now see, they have realized the machinery for 1 lakh rupees, whereas the book value of machinery was 2 lakh in the balance sheet. Building, its book value was 4 lakh and now it is being realized for 5 lakh. Investments, its book value was 1 lakh, now it is realized for 1 lakh. Debtors were 50,000, now it is realized for 50,000. Stock was 50,000 and it is realized for 50,000 as well. Now the total assets realized is 8 lakh. You can observe there, goodwill and profit and loss account deficit are not realized because they are not realizable assets. Goodwill cannot be realized, it's not a realizable asset. Profit and loss account is a fictitious item, that is a fake item. It's a loss actually, it cannot be realized. Therefore, the total assets realized is only 8 lakh. Now with this 8 lakh, the company has to make payment to its debts. So now if the company initiates payment, firstly it has to pay to its outside liabilities, that is debts. So here the outside liabilities are debentures, bank loan, bills payable, creditors and bank overdraft. So they have been paid. You can see the debentures are paid 2 lakh, bank loan 2 lakh, bills payable is been paid 50,000, creditors 1 lakh and bank overdraft they have been paid to the extent of 50,000. So their dues are being paid. Now the total payment made to liabilities is 6 lakh. Assets realized were at 8 lakh. Payment made to outside liability is 6 lakh. Now the company is left out with 2 lakh and this 2 lakh now belongs to equity shareholders because they are the owners of the company. After paying all the outside liability, whatever is been left out, that belongs to the owners. Now you can observe, even though the equity shareholders have invested 4 lakh rupees in the company, at the time of liquidation they have got only 2 lakh. Since they are the owners, the risk is also associated with it, therefore they have to undergo this kind of sacrifice. If the same situation is taken and if the asset realized was 8 lakh and the payment made to liabilities were also 8 lakh, then equity shareholders would not have got any amount at all. Since because they are owners, they have to bear such risk as well. Now let us take one more example. In this example, unlike previous example in the balance sheet, here we don't have bank overdraft and a liability, and we also don't have profit and loss deficit balance under assets. Apart from that, here we have reserves and surplus of rupees 50,000 and under assets we have bank 1 lakh rupee. Now if this is the balance sheet of a company and if this company tries to liquidate, let's see how that process would take place. And if they try to realize the assets, so this is how they have realized their assets. Machinery book value was 2 lakh, they have realized it for 1 lakh 50,000. Building was earlier 4 lakh, now it has been realized for 6 lakh. Investments were 1 lakh, now it is realized for 2 lakh. Debtors were 50,000, it is realized for 50,000. Stock earlier 50,000, now it is realized for 50,000. Bank 1 lakh rupees. The total assets realized are 11 lakh 50,000. As said earlier, goodwill cannot be realized because it's not a realizable asset. So now if they initiate payment by utilizing that 11 lakh 50,000, now first they have to pay to outside liabilities. So the debentures is paid 2 lakh, bank loan is paid 2 lakh, bills payable 50,000 they are paid, creditors 1 lakh is been paid. So the total payment made to liabilities are 5 lakh 50,000. So out of 11 lakh 50,000, total payment made to liabilities is 5 lakh 50,000. Remaining left out is 6 lakh. So that 6 lakh will be given to equity shareholders. That is the amount available to equity shareholders after making payment to outside liabilities. Whatever is left out, that belongs to equity shareholders. Now you can observe in the balance sheet the equity shareholders capital is 4 lakh and we also add reserves and surplus. Reserves and surplus always belong to owners. So now actually their claim was 4,50,000 in the balance sheet, but after liquidation they have got 6 lakh rupees. Therefore, equity shareholders get surplus of rupees 1,50,000 apart from their claims of rupees 4,50,000. Unlike the previous example, in this example equity shareholders gets more amount than their claim in the company. In simple words, liquidation refers to realization of assets and utilizing those cash in order to pay outside liabilities, and then if surplus remains, if any surplus is there, that will be paid back to shareholders. If you have liked the video, please do subscribe. Thank you for joining us.